Hello and welcome to Fidelity Connect. I'm Glenn Davidson. Europe is seeing a resurgence in investor interest as President Trump's tariff policies continue to fuel concerns of an economic downturn. Market participants have turned their attention beyond the U.S. Is there more room for international markets to rise? And which investment themes is our next guest watching closely? Joining me live now from London to unpack his perspectives on the global market landscape is Fidelity Investment Director Tom Stevenson. From across the pond, welcome, Tom. Good to see you.
Thanks very much, Glenn. It's a pleasure to be with you again.
Well, it's wonderful to see you, and I know that not only me, but our viewers will be very interested in your perspective as someone that's not residing in North America. So I'd love to take you back to September, the last time that you were on this webcast. You talked at that point about the known unknown of the U.S. election that was upcoming. Things have happened since. Give us your thoughts on what are your observations? What's a macro take from you, Tom, on what's gone on?
Last September seems like a very long time ago, doesn't it? I mean, that is a different world. Back in September, we knew the election was coming. We kind of had a sense of the direction that it was going in, and that was okay because we'd seen from 2016 this movie play out before, so we knew kind of what we were expecting with Donald Trump if he were indeed to become the president, which he did. And with Donald Trump, of course, there were good things and bad things. And in this context, by that, I mean, there are market-friendly things and market unfriendly things. And I think the view then was very much a glass half full view. We were looking at the possible tax cuts. We were looking at deregulation. And we were kind of pushing to one side and not thinking too hard about maybe some of the more negative things that we'd seen in the first term and maybe which we were expecting in the second term, specifically the tariffs, of course, which have become such a big issue. But I don't think that we were really thinking about, the inflationary consequences, the growth consequences, which have become the focus now. But at the time of the election, and indeed in the weeks after Donald Trump came to the White House, we really weren't too concerned about those things. So there's been a big shift, a big turn in the narrative since the markets peaked about a month ago.
Indeed, there has. And that's led to a word, tariffs, that is talked about constantly. You were on the BBC this morning talking about a tariff-related market correction that we've been seeing, and also thoughts on the upcoming Fed meeting this afternoon, our time. Could you talk about what was discussed with the BBC this morning, please?
Yeah, so, obviously we've had, in the last month since the February the 19th peak in the S&P 500, we've had, a pretty big turndown in the market. At its worst, a 10% fall. So, that's how we generally categorize a market correction. A 10% fall. We had a bit of a rally on Friday and Monday, and then yesterday, Tuesday, the markets turned lower again. So that was clearly the topic of conversation on the BBC. They wanted to get my take on what was going on there, and it's all about the US. I mean, what I was saying to the BBC this morning was that this really is a US phenomenon, because if you look at the performance of markets generally across the world, they're actually, they've been pretty good over the last month. If you look at, Europe, Japan, China, the UK, all of those markets are broadly flat or even up a little bit compared to a month ago. It's just the US which is down. And that is all about the impact of tariffs. It's about the inflationary impact. It's about the impact on economic growth. And that's really what is spooking investors at the moment in the US.
And could you comment on the change in trading partners that we are starting to see? There's a repatriation of funds, obviously, through different areas of the market globally, but also, I think, a re-engineering of trading partners. Mark Carney, our Prime Minister, has gone over to the UK and France versus going to the United States for his first set of meetings. What do you think of that from a trade standpoint?
Yeah, well, I mean, it's a very interesting step, isn't it? For a Canadian Prime Minister, typically their first visit is to Washington. It's not to London and Paris. So I think that that is sending out a very clear message. Mark Carney talked. He didn't mention the president by name, of course, but he talked about reliable allies, and that was a very for me, that was a very interesting expression to use, and it does hint at a kind of reshaping of the web of international trading relationships. Now, this is not going to happen overnight, but it's clearly something which is being thought about in many countries around the world, which are on the wrong end of Donald Trump's trade and tariffs approach.
And are you seeing capital inflows into the EU through different businesses, but also through defense spending?
Yeah, so we're seeing, a very interesting survey came out this week from the Bank of America. It's a fund manager survey. It's a kind of, it takes the temperature of global stock markets and where professional investors are thinking about putting their money. We've seen one of the biggest inflows of funds into European passive funds initially. Now, that's interesting because what investors tend to do when they want to get a quick exposure to the market is they exercise that position through passive funds initially, and then they tend to move towards active funds when they've had a look at the market, had a look at who's performing, where they want to put their money. So this is very much the early stages of an asset reallocation towards markets outside the US. In that same report, we learned that the exposure to the US market has fallen just in a month between February and March from a 17% overweight towards the US to a 23% underweight to the US. That's a 40% swing. It's a massive swing to happen in such a short space of time. So where's that money going? A lot of it is going towards the markets which have been more out of favor. They're much cheaper, and Europe is a classic. Now, you mentioned the defense spending there, and that is one of the stories which is exciting investors, because clearly one of the consequences of America's apparent withdrawal from, if you like, the transatlantic alliance, which has held sway really since the Second World War, has been that Europe needs to stand on its own 2 feet in lots of different ways, but in particular in terms of defense spending. And just this week, we've had news from Germany that the outgoing parliament has approved what's called a debt brake, so allowing the German government to borrow more money than they would have been allowed to before in order to spend heavily on defense spending, but also on infrastructure spending as well. So, that is potentially a big boost to the industrial base in Europe, and in particular in Germany, which of course is the economic engine room of the region.
You referenced the focus on the United States and the fact that we've seen flows go out of the US into the EU and other areas around the world. Tom, do you think this is a healthy thing that's going on? Was there too much focus in one area, and this is actually quite good to break things apart and retool?
Well, I mean, in some ways it is a positive. I mean, in some ways, I think it is a positive for Europe. Now, there's a lot to do, and there's a lot of uncertainty about whether all of this will actually happen. But if Europe as a region can become more independent, can spend more productively on things like defense and infrastructure, then I think that has to be a good thing. Clearly, markets had become very focused on, investors had become very focused on the US market. I mean, the US market represents, I think, about 70% of the value of global stock markets. That's very, very concentrated. And, when a market becomes that concentrated, it becomes vulnerable to a reversal, to a switch. And that is, that's what we've seen.
So fair to say US growth got very expensive. And in fact, the Magnificent Seven distracted from a lot of opportunity globally, but that opportunity now is more obvious to investors, isn't it?
Yeah, I think so. I mean, I think we're seeing opportunities in many different parts of the world. And the one we've talked about there in terms of German industrial spending is one area, but there are many other areas of growth which is much more attractively priced. If you look at pretty much all the other markets that I've mentioned today, the Japanese market, the European, the UK in particular, the Chinese market, they're all massively less highly valued than the US, and in particular that end of the US market, the Magnificent Seven, the big tech stocks had become.
And let's talk about Japan. You just mentioned it. It seems that things are becoming healthier in Japan. Do you think that's a fair statement?
Yes, I think there are lots of good things going on in Japan. One of the good things is that, and this seems strange to say from a European or a North American perspective, but they've got inflation again, and actually that's a good thing. After decades of deflation, the fact that they've got a sort of healthy rate of inflation is being seen as a positive by investors. We're just about to go into what they call the shunto round, which is the spring wage setting round. And the expectations are that it's going to be one of the strongest ever. So, Japanese consumers are going to have more money in their pockets, and that is going to feed through into a much healthier economy in Japan. At the same time, there's a lot of reform going on in the Japanese market in terms of how businesses conduct themselves, and it's being encouraged by the government. It's becoming a much more efficient and effective economy, and that is starting to shine through into better valuations as well. So we've got a healthier economy, we've got better governance reforms, and you put those together, and it's looking like quite an interesting opportunity. And again, the valuations now they're not as cheap as in some other markets like the UK, for example. They're more expensive. They're closer to the American valuations, but they're still a long way behind the Americans in terms of valuation. So good valuation, healthier economy, and good governance. It's quite an attractive opportunity, I think.
Very interesting. And China, Tom, your thoughts?
Yeah, so again, China has been, such a disappointing market for so long. I mean, it was very slow to come out of COVID. That was one problem. The second problem was, interference by the authorities, by the government in the running of companies. Now, there have been changes on both fronts, really. I mean, the government has really stepped back from being quite so heavy-handed with companies. It's now encouraging its tech sector in particular. It sees an opportunity there, particularly in the AI space. So, businesses are feeling more confident. Consumers are starting slowly to feel more confident. And the market had become so cheap. It had become so out of favor. I mean, people talked about China being uninvestable. Well, now they're starting to talk about it very much being investable again. And, parts of the market, the Hong Kong part of the market, for example, which is more sort of tech heavy, has been a really strong performer year to date.
You mentioned consumer. As a Canadian, I've got to ask you this because our viewers are Canadian as well. We have a retailer here in Canada, and maybe you went to visit them last time you were in Canada. Hudson's Bay Company, 355 years old, and they're facing liquidation. My dad worked there for 48 years. He's upset to see it. Canadians are upset to see it. What do you think about, let's maybe look at your own market. Let's look at the UK first. What do you think about the state of retail and the state of the consumer?
Well, it's quite something, isn't it, when a name that's been around for literally centuries.
Exactly.
I mean, that is a sign of the sweeping changes that are moving through the global economy, and it is a global issue. I mean, here in the UK, we've a number of sort of venerable names in the retail sector, which likewise have just gone out of business. This is particularly true of the sort of generalist retailers, the department stores, a company called Debenhams, just disappeared. And, that has knock-on impacts. It has, in particular, it has interesting knock-on impacts in the real estate sector. I mean, the retail side of the real estate sector has really been on its knees for many years. Now, interestingly, just before I came onto this call, I was talking to our head of real estate here at Fidelity, and he was talking about the opportunities in various parts of the real estate market, offices in particular, logistics. But he mentioned retailing and saying retail has really been through its pain. It has bottomed out. I mean, if things were going to go under, probably it's happened by now, and we're just seeing the end of that process. So, I think real estate is an interesting area for investors to look at, particularly if you're looking to diversify your exposure away from a pure equity exposure. Real estate is one great way to diversify a portfolio.
Interesting. We should talk about asset class diversification. You've given us a great understanding so far of opportunities that are around the world, so we can look outside of North America for sure. But let's talk about asset classes. What's going on with the traditional 60-40?
Yes, well, I mean, the 60-40, 60% equities, 40% bonds has been, for many years, there's the sort of classic way of balancing a portfolio, creating a diversified portfolio, giving investors a smoother ride. The reason why it's worked has been that shares, equities, and bonds have tended to be uncorrelated. They've responded to the same circumstances in different ways. So, if the stock market rose, then the bond market fell, and vice versa. Now, I think there is some evidence that negative correlation moving in different directions is maybe not the case anymore. So I think that the days of a simple diversification strategy of simply holding some shares, holding some bonds, is probably gone. And I think that investors looking to diversify their portfolios probably need to look a bit further afield and invest in some, a wider range of assets. That might include property. It might include gold. It might include infrastructure. It might include bonds as well. But I think it probably involves more of a mixture than it has done in the recent past.
You mentioned gold. Gold futures, last I looked, were up on the prospect of the Fed meeting this afternoon. Thoughts on gold? It's done very well this year.
Yeah, I mean, gold is the classic safe haven. People buy gold when they're unsure about what's going on in the world. And the one thing that we do have in spades at the moment is uncertainty. It's quite interesting how well gold has done. In as much as it has happened at the same time as interest rates and bond yields have been relatively high, because gold typically does not do well when there are alternative sources of income, because gold doesn't pay an income. So it would tend to fare less well when there are good options for generating an income. So the fact that it has done well in that circumstance, I think, is an indication of the sort of level of concern that many investors have about what's going on in the world. So it's broken through $3,000 an ounce. It's not coincidental. It broke through $1,000 an ounce at the time of the financial crisis. It broke through $2,000 an ounce at the time of COVID. Perhaps not surprising that at a time of equal uncertainty in terms of geopolitics and domestic politics, that it should have broken through $3,000 an ounce.
You mentioned correlation, Tom. I'd love to ask you about high-level thoughts on crypto, on Bitcoin, which people had thought of maybe adding into their 60-40 mix. Seems to be very correlated to the NASDAQ these days. Would you agree?
I think the thing about Bitcoin is that it's a volatile asset. It is a risk asset. you're absolutely right. It is highly correlated with the riskier end of the stock market. So I actually do think that there is possibly a place for a very small weighting in Bitcoin as part of a very diversified portfolio. It behaves similarly in some ways to gold, but I think in a broadly diversified portfolio there may well be a place for it, but I think it's quite a small proportion.
Thank you. A question came in from somebody in the audience, and they were just asking, in the case of the EU, are they looking favorable because of all the negative sentiment in the US, or is it really that the fundamentals in the EU are stronger than elsewhere?
Well, it's a bit of both, to be honest. I mean, money is leaving the US and it's looking for a home, and it's found a potential home in the US where a number of things are going in the right direction. So, earnings are picking up in Europe. Interest rates are falling. The direction of travel for monetary policy is much easier than it is in the US and indeed in the UK as well. We've got this fiscal impetus that we've talked about with the defense and the infrastructure spending. The export market to, for example, China is very important for Europe. So if things are picking up in China, that's also second derivative, a positive for Europe as well. So I think there are a number of positives for Europe, but it's clearly being helped by the sentiment about the US as well.
Indeed. Tom, you have a very interesting LinkedIn profile. You constantly post about all the activities that you're doing, including this morning's piece on the BBC. So I hope our viewers will follow you on LinkedIn. One of the things you usually do, or you always do at the beginning of the year, is talk about your top 4 themes for the year. What are those themes for 2025, given all that's going on?
Yeah, so I always come up with some fund recommendations, which will not be of relevance to your audience, but the themes certainly will. And one of the things that I was thinking about at the beginning of the year when I was coming up with my recommendations was this rotation out of the US. I was expecting some kind of a rotation. It was not so much to do with the tariffs, although that was part of it. It was mainly to do with valuations. It just felt to me like, particularly the Magnificent Seven had become, overvalued. There'd been too much hype on the AI story. So it just felt vulnerable to me. So I wanted to move away from the US, and in particular from the large cap US. So one of the things that I thought would happen, and actually I've been slightly disappointed so far, was I thought that there would be more of a rotation from large cap to small cap in the US. Now, so far that's not happened. And that I think is to do with, the fact that there is a growth scare going on at the moment. People are concerned about not just inflation, but growth as well. And that's impacted smaller companies.
And Tom, could I ask you about that? If I could just ask you about that, the potential move to small cap. Lower interest rates typically help those small cap companies, don't they? And then that's not maybe the case.
Yeah, absolutely. And I think in due course, 2 months is a very short time to be making any judgment about what you've said about the stock market. I do think in the long run, I think that call will probably be right, because the valuations are much more sensible in the small cap arena than they are in the large cap. But the thing that I really got right was this move away from the US. So I actually think that for most investors, investing on a global basis makes sense. I think that the diversification which it provides is important. It's a bit difficult to do that because in a prudent way, because global funds tend to be very focused on the US. So actually, if you're investing in a global fund, to a large degree, you're making a bet on the US market. So, I found some funds which were really very underweight the US. They have more of a European exposure, more of a value-based exposure rather than a growth focused exposure, and a much lower weighting towards the US. So that has certainly paid off. There's been a big outperformance by those just in the first 2.5, 3 months of the year. The final theme which I was really looking at was here in the UK, there's been a real focus with our newish Labour government on boosting the infrastructure, the fabric of British society, increasing the productivity of our economy. And one of the ways that they're looking to do that is by investing heavily in our infrastructure. So, I found an infrastructure investor which was trading at a big discount, because there's often quite a lag between these changes in the themes and the money catching up with it, with the investors catching up with it. The head of real estate that I was talking about earlier on, he mentioned this in the commercial property market. He says it's very often a real lag between the change it's obvious what's changing on the ground. You can see it happening on the ground. It takes a bit of time for the money to follow that change in thinking. And that's very much the case with infrastructure. It's still quite out of favor, and it looks like a very interesting opportunity here in the UK.
You recently did a presentation to a large number of people, I think it was 700 people in London, investors, advisors. Did you find that there was a positive vibe from that group, especially through your Q&A?
What I found was there is at a time of change like we're going through at the moment. These people I were talking to they're active investors. They understand the reality of what they're doing. They understand that some things are not going to be doing so well. That their US investments have let them down over the last month. But they recognize that is creating opportunities elsewhere. And what I'm finding anecdotally, there's a huge appetite for investment ideas. And, what I've been talking to them about is there's a wealth of ideas all around the world, different countries, different asset classes. And so there are great opportunities. And I think that was the feeling I got from it. It wasn't so much a sort of optimism, it was a realism, that things are difficult, but there are opportunities.
Well, I was so glad to hear that you had time on the BBC this morning as a warm-up for your Fidelity Canada webcast today. It was wonderful to speak with you, Tom, and the wonderful opportunities in the world of opportunity, the wealth of opportunities, as you put it, globally, are something that's very important for all of us to look at, and we appreciate all of your input today, Tom.
Thanks very much, Glenn. It's been a pleasure.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.